Hi, this is Brent from TradeGuild.blogspot.com. It is January 3rd, 2007. Happy New Year. The market was closed on Tuesday because of the passing of President Gerald Ford. Our market was closed, rather, I should say. So the rest of the world had a little party without us. Up on the screen, I've got the London FTSE. You can see a nice move there in that index. The Frankfurt DAX, nice move there. The Hang Seng, nice move there. So I think our market participants were looking forward to getting a little piece of the action that the rest of the world saw on Tuesday. And the market started out that way. It looked pretty good going into today's trade. And I think the FOMC minutes from December that came out today rained on the parade. And basically, here's some of the quotes from that meeting. Downside risks to economic growth in the near term have increased. Economic activity in the second half of 2006 was a touch softer than had been expected, and the data showed an increased risk of inflation failing to moderate, and it remains a predominant concern, which diminishes hopes of a possible interest rate cut anytime soon. So, let's go ahead and take a look at our indexes today. First up on the screen is the Dow Jones 30. And the first thing you'll probably notice is the big volume here today and the very big price range that we saw today. So we didn't get very much price appreciation out of it, a tenth of a percent it looks like. So this would be normally indicative of distribution. We had a huge influx of money coming into the market today, whether it be portfolio rebalancing or hedge funds coming in with new funds or whatever the reasons may be. We had a lot of volume come into the market, and we didn't see a price gain. We didn't see a price appreciation. So it seems like there was a lot of money going right back out as well. A couple things I want to point out real quick. So we're thinking maybe there's some distribution here. I've got a new indicator that is a custom indicator that I wrote on Telechart, and it is a custom cumulative indicator, and it's based on time segmented volume. So it is read using divergences. We're looking for divergences. So here it is. It's in red, and there's the Dow Jones. So you could see everything looks like it's pretty much, for the most part, in gear. There is a divergence right here, relative speaking. We're just a slight bit higher, although price is quite a bit higher. But if we take a look at the hourly chart, if I can get it up here, there we go. The hourly chart on this indicator, you can see a pretty deep divergence has taken hold over here where we're making new highs intraday, and this guy is way down here. So that was a pretty bad indication early on in the early going. Also on this pullback over here in December, you can see it dipped down way low back to the readings that we were getting in early December. So there was quite a negative divergence there, and you can see that this indicator is pretty special. I really like how this thing works. Let's take a look at the SPY, which is the spiders, the ETF for the S&P 500. Again, we're looking at an hourly chart here. We can see that same set of divergences. In this one, it's pretty bad. So you can see as we're making higher highs here in price, this indicator was headed down. So over here, it's in actual lockstep. But this pullback, which was shallower than the previous one, was deeper on the indicator. That's divergence. Again, we saw it over here. As price was actually popping up a little bit, this was hitting new lows for the month. And the rally that we saw today that brought us up close to new highs, it should have been, the indicator should have been up here at this level, and it was way down here. So big negative divergences there, working on this new indicator that I haven't named yet, but we'll get around to that. One of the other things, we can look at some of the classic indicators here, and up on the top I've got money stream in red with its moving average 20-day. You can see it's under its moving average, and you can see that it's divergent over here it's pulled down way, way below these levels over here. So that's a negative divergence. You can see time segmented volume 18 has been heading down, and even unbalanced volume over here, which I don't use very often, is moving under its moving average. Let's take a look real quick at the Qs. It's going to be the same old song over here on the Qs. Let's pull up my special indicator. And on this one, you can see there was a pretty bad divergence right here. This indicator should have been up here, and you can see it was heading down, and now it's quite low. And if we look again at the hourly chart, you can see that it's gone ahead and broke down here to lows that we don't even see on this chart for several months. So the QQQ's looking pretty bad. I actually bought some of the QID for a market portfolio on Zacks. If I have a little dry powder laying around, I might get some of that for myself. And that's an interesting play on a short on the Qs. So let's take a look at some of the other things that happened today. One of the big movers and shakers today was the US dollar. And there's that US dollar index that we've been watching. We've been talking about a bounce from early December. And today it had quite a strong move. I think this was about the strongest day it's had in about 6 months. So this affected a lot of things, as you might imagine. We've been talking about being long, last month anyway, we were talking about being long in gold and energy. Well, a couple bad things have happened in both, and this strong dollar directly has affected gold. We'll take a look at some of that here in just a minute. What happened with the dollar today? The ISM manufacturing index came in above 50, which indicates expansion, which puts that soft landing idea back in play. And I think the next hurdle that we are going to see is going to be the payrolls on Friday that are coming out. Now, ADM, which is a payroll company, gave us a little preview today. Payrolls fell 40K versus a November rise of 158K. So this is of concern for the US dollar going into Friday's payroll report. So we'll see what happens there if this continues to break out to above this consolidation area, or if it just goes ahead and heads back down, which will be good for gold. There are some gold stocks that are still acting well, by the way, and maybe we'll take a look at one of those if we have time. So let's take a look at gold, and like I said, the stronger dollar makes gold more expensive. So you can see what happened here in gold today. This is the XAU gold silver index. Big hit, very big hit. It's broken down here to new lows for the month, or for 30 days, and it's broken through the last remnants of what I consider to be pretty respectable support in that area. Let's see, what else do I have for you here? Let's take a look at gold itself, GLD. And again, just a huge breakdown here on big volume. So this is not a good thing. Silver looks a lot worse than gold, actually. But we'll see what develops on Friday. Now, weather forecast came out. The other thing we were hip to was energy. Technical analysis, unfortunately, does not consider weather forecasts. It's not something that you see on a chart. So weather forecasts have come out, and they expect warmer weather in the Northeast through January 15th, and the Northeast is the largest customer of heating oil. So we're going to take a look real quick at the USO. I'll try to get all this in. USO breaking down there. This is the United States Oil Fund ETF on pretty decent volume, and that's directly attributed to the weather forecast. Plus, the rising dollar doesn't help matters at all. Let's take a look at XOIL, which is light sweet crude. You can see it's broken down today. It was down 4.5%, or $2.73. So I'm running out of time here. I'm going to come back with another video. I'm going to do a couple more, actually.